Cool. I think we're good to go. Okay. Hello, everybody. See some new faces out here. Good to have you here. This is D-Control. It's a hackerspace that's been around for quite a while now. And welcome to ETH Vancouver. So every week, every Thursday, we do a talk or hang out or do a panel. We'll have something for you every week, every Thursday, 6 p.m. And today we have Ethan and Will talking about stablecoins. So I'll let you take it away.
Hi guys, my name's Will. I work for Trade, I guess. We are a yield strategy market, both stable coins but also for other things like just have a bunch of individual strategies that are quantitative, and basically we allow our users to select what's best for them, their risk profile, what yield they're looking for. Then they can try out some typically hedge fund strategies that aren't available to everyone, garden type thing, on chain to our app and try something new.
And yeah, this is their site. So different kinds of yield strategies. We're gonna get into it. But this is like teaser.
Yep.
So
Get excited. Get hyped.
Yeah. And I'm Ethan. I'm building a stablecoin credit protocol. So it lets you do like fixed rate borrowing. It's called ibisu.money. And yeah, we're here talking about stablecoins. It's a huge narrative this past year, because it's one of the few things in crypto that actually like has product market fit and works.
Stable season.
Stable season, yeah.
Yep.
And Will and I are just like enjoyers, researchers of the space. But it's like the good thing about ETHVan is like we can have a discussion and stuff. So we prepared some little bit of like information about stablecoins, from like basics to more complicated stuff. But like at any time, please feel free to like raise your hand, like talk about anything. Yeah, let's keep it. We can like discuss and stuff.
Yep. You don't even need to raise your hand. You can just scream out something. Feel free.
And we'll give them a mic.
Yeah.
Okay. Cool. Oh, you have some. Okay, so stablecoins. High level, we're going to talk about like what they are, what they're used for, the different designs, and then things that we're finding interesting about it. So, and then at the end, maybe some like risks that they're posing to the system. So, high level, like what's stablecoins for? I think like three different categories of things. So, saving your wealth, like stablecoin is a way to store value on chain. So, you can denominate your wealth in USD stablecoin, Euro pegged stablecoin,
Swiss francs.
Yeah. And just like have that value on chain versus like in a bank or whatever, or in cash.
I think that's to touch on that too. I think we're seeing a lot of we are seeing a lot of popularity of that in like South American countries and such, where essentially their currency is pretty cooked. Not gonna lie. So an easy way to get or hold value against your devaluing currency is to just come on chain. A lot of different options: USDC, USDT. So really great for those populations to be able to access US dollars.
A digital euro dollar kind of thing. And like, why is it cool? It's because blockchain is like a database, global database, shared state. It's good for this kind of use case of like accounting and custody of things that you want to make sure it's like the accounting and custody is like bulletproof. So, okay, that's saving. Spending and sending. So transferring value, like you have this value on chain, you want to transfer it between parties, like pay your relatives or someone, like do an invoice. Like blockchain is just like a good way to make sure the payment works, and it's you pay a low fee, keep global permissionless. The fee doesn't scale with the amount or how much kilometers you send it across. And then earning. This is like kind of like the frontier, I would say. It's like you have this money on chain. Now, what can you do with it to like allocate it productively? In normal finance, we have like so many different ways to put your money to grow it, and like the on-chain economy is like offering a lot of different kinds of yield sources too. So yield is good. Like you want to ideally have the money that's sitting in your bank, like beating inflation, protecting your spending power, and the more risk you take, you can even like generate like substantial returns that are like more like similar return profile to like more risky type investing, but yeah, it's just because on chain there's like I think the risk-free rate for stablecoins is like higher than off-chain risk-free rate, so you can actually earn like 20-30% APY on dollars, which is like a way to grow your wealth without being exposed to volatility. So
Yeah, I think touch on as well, like as far as like payments and such go, like really huge narrative right now. Like you have I think it's free dot pay. You have like new unicorns and such popping up. A lot of different like real life use cases outside of DeFi. An example could be, let's say just picking stuff out. You own a restaurant, right? You need to pay employees every 2 weeks. That money's just like chilling in escrow, doing nothing, hanging out. With these payment networks that allow you to use stable coins and such, different stable coins, including yielding stable coins, you can actually, business can, earn something in that escrow account before it's being paid out to employees. So it's just more productive. While it isn't necessarily a loss for it to sit there, it could be a gain.
yeah, like why is the money in your RBC like checking account like not earning anything? Like,
Yeah, 0.1% or something.
Yeah.
Right?
So still almost on the basics, but like some stablecoin use cases, who uses it? So like we've heard of like stories of like people like leaving war-torn countries with like a seed phrase in their underwear, and like that's like their ticket to pay like the, what do you call it, the smuggler, like to get them across the border. Like having like like custody over your own wealth and like control over that is like a huge thing for a lot of people, like a huge upgrade to like life. So as long as you have internet connection or even just like seed phrase, you can custody wealth. In more developed like economies, payments is like a huge TAM, but it's like really like old market structure where like you're relying on these kind of like hodgepodge of like intermediary banks, and like it doesn't work at night, and it like high fees. So blockchain is like a really clean solution just for like cheap payment rails. Like one state, everyone has an account. You transfer your debit and credit balances between these accounts, globally scalable. That's why we're seeing things like Tempo and all these like Stripe and all these like incumbents stepping in like the crypto space to basically just like usurp Visa and MasterCard payment network to like, that's like I guess the huge TAM that everyone's going after.
100%. And I don't know if this is necessarily on point here, but another big thing like crypto cards and such, we're seeing a lot recently. I think it's EtherFi that allows you to deposit your USDC, I believe it is, into one of their many vault products, which yield 9, 10, 11%, whatever it is right now. I'm not too sure. But actually borrow off of that and, tap your card and, I don't know, buy a slushie or something. And, maybe your borrow rate's 5%, but what you're using as collateral in the vault is exceeding that. So, I don't know, it's just to be honest, really great way to pay, but you do also see some funny things, like when AWS was down a few days ago or something, and people with their crypto cards were, just struggling to pay still. So it's like, I feel like there's a lot of cool stuff, but, we're still so much further to go. Not everything's perfect yet, but a lot of great things so far.
Like I use this EtherFi Cash as my primary way to like spend money because personally, like I get paid in stable coins and 0 fees for off ramping, 3% cash back. It's like the best UX ever, and it's enabled by this thing called Rain. Rain is like a fintech provider that basically like cuts out like the interchange fees between banks by doing all of these kind of like money transfer stuff on chain. So they have license to do like basically what a bank does, but with stable coins, and that's how they're able to offer such like a seamless UX. So yeah, it's getting there. Okay, then last bucket of stablecoin user group is like crypto natives. It's always like the frontier, like the innovators, those people pushing the boundaries, and that's where we see things that are like kind of financial experimentation, heavily relying on like the composability that's enabled by blockchain to like create like new financial primitives, like different kinds of very like Ponzi's or also like cool stuff. But I don't know, like free market's gonna do its thing and figure out and it's gonna innovate, and like things will die. But that's like where I spend a little bit of time as well. Like what new things are enabled by having the whole of finance on chain.
I think, yeah, like experimentation is one of the things that I really like about DeFi. Like you aren't really restricted by regulations and stuff, so you can really try a bunch of different things. But it's really important to, fully understand what's going on, your exposures, risks, like money Legos, composability, all super cool. You can do a lot of crazy things. We'll get into it, looping, whatever. But then you also get like composability, systemic risk. It's like you see some like maybe some similarities there where some interesting things could happen. But again, all about experimentation.
Mm-hmm. So like we're yapping a lot, but here's like some data. So this is like stablecoin market cap across all chains, like 300 something billion. How much cash? Like let's guess like how much cash is in the world circulating?
I'm a vouch for that. I'm gonna go with that too because I have no idea.
Like 80 to 150 trillion. So crazy. Like it's still just a drop in the bucket, but imagine how much fees these guys are wasting, man. They should use.
Yeah, just jump on DeFi, bro.
So it's still small, but it's been growing a lot. Like it's like one of the hottest. I think like this is catalyzed by this recent.
Oh, I think we're getting a little cooked here.
Anyways, recently Trump made it like Genius Act, all this like bullish regulatory climate. Like big money is starting to like tokenize their bank deposits into stablecoins, and that's where we're seeing like an uptick of stablecoin supply. And like liquidity begets liquidity. Like it's only up from here, boys. But
yep, CZ got pardoned. It's back. Crime season. Nah, JK. Yep, it's experimentation. Chill.
Okay, so this is like the oops. I want to also dive into like what's the breakdown? Like what is actually comprising of this market cap? Like because there's many types of stablecoins which we're gonna get into, but I think it's you can find something interesting when you look at what's the breakdown here. So
this was on purpose. We needed to kill a little time.
Yeah. Who here stores? Who here's money would be more in stablecoins than fiat?
Raise your hands, yo.
Yeah,
great numbers. Not me.
Maybe
I don't have money. Yeah, I'm broke. That's why I use a credit card still.
Who receives payments in stablecoins for work or friends? Yeah, I wish.
Yeah, on the way, man. On the way.
Wait, who here has sent a bank wire in the last year? Right, so heinous, so bad. Oh my goodness, what even is that? Okay, so yeah, I'm aware.
I'm not sure. Basically, just wires. Sorry.
Yeah.
Yeah, so there's two ways to send money through the bank. There's wires, which are, I think, a little bit faster, but cost more money on the receiver send. And then there's ACH transfers, which is what Wise uses. I use a company called OFX, which is an Australian company similar to Wise. And that's the way I send money to my suppliers in Europe. Like I send USD and they get euros.
Yeah, so we're aware like Swift, ACH.
Yeah.
How much does it cost and how long does it take?
I feel like, I haven't checked the cost in a while, but I feel like it's approximately like under 0.5% of the real rate. Like I'm paying less than 0.5%. Like if I convert euros to USD and on Google, I'm under under 0.5%. So it's nothing like TD Bank, which is like 2-3%. No. What I'm saying is the spread. So I'm sending USD to them, and they're sending euros to the supplier. Yeah. So when I look, I'm like I'm losing maybe like it's under 0.5%, and it's pretty quick. It's like 2 2 to 3 days, I would say, approximately.
Okay.
Yeah, so it's not terrible, but it's obviously not as fast as crypto.
Yeah.
I will
Interesting.
add. I just signed up for Wise yesterday, and I moved a bunch of Canadian, like not a bunch, like $3,000 Canadian into Colombian pesos, and it still was like almost $60 worth of fees, and then you get these exchange that you get on Google, but it was like basically just a little better than if I just was like paying for things with my Visa, because it's like I think it's like 2.5% to 3% as opposed to like 3.5 to 4% or something like that. So it still felt, I thought it was going to be like an unlock, and it was like, this is still brutal.
I feel like some currencies might be worse than others, though. Like
I've heard that.
US to euro is probably a better spread than Colombian
I've heard that the
pesos.
Colombian peso for some
Yeah.
reason is super expensive on there. So
Yeah.
maybe because there's war with the United States right now.
Yeah, exactly.
And it's kind of interesting how, as you were saying, like, I think it was 0.5% or a bit under 2 days, which I guess I'm not as familiar with, that realm. Is quite quick, not too expensive, but it's kind of interesting. Like me coming from crypto, DeFi, that's where my familiarity lays. Is you go to a decentralized exchange or something, and it's like 0.5% slippage or something, and like people are like super complaining. It's like, that is crazy, that is insane. Or it takes more than like 3 minutes, and it's like, oh, yoinked, funds gone, what happened there, right? So it's kind of, I don't know, it's interesting, the parallel between what crypto considers fast and cheap versus, I guess, what is traditionally fast and cheap. Yeah.
I wanted to simulate a transaction, but like my project just deployed on Plasma. It's like a new stablecoin chain. We're also on Ethereum, but like when we do payroll, for example, I'm sending money in one transaction to like 5 guys in 5 different countries, and on Ethereum the cost is maybe like less than 50 cents or like $1 if like Gwei is low. The chain is up to like maybe a couple dollars if like everyone's using the chain, and then it's instantaneous, and the fee doesn't scale based on the amount I'm sending. It's just like a fixed fee. Even if I was to want to pay that guy in euros, I would pay a fixed gas fee plus I could route it through like multi-hop transaction, and it would incur some slippage on the swap between USDC to like the euro stablecoin, but the slippage is like all in all less than whatever you guys are paying. And I've only ever been paid in stablecoins, and then like, so it's like heinous for me to hear friends doing this. Like, yeah, it's just
I'll just say, what you're saying reminds me of that it takes 2 to tango. That's the issue. Like, trust me, I hate spending an extra 20, 30 bucks. Like, after hearing this, I would go home and, can I pay these guys in stablecoins so I save money? But on the other end, it's a very old, traditional, like, if I start talking to these guys about crypto, they're going to be like, get out of here.
I guess it's like, how can you...
So it takes 2 to tango, basically. You need both people.
I think like yes, but hopefully no soon. Like ideally you can abstract all that away, just having like stable coins in the background actually, function these fast transfers that are all cheap. Like, from how I'm aware, like these payment services like Re.Pay and such, they handle all like the stable coin movements and such. All you really need to care about is, onboarding CAD, and then sends to whoever you want, whatever country that's, available, and then automatically offboards into their native currency without really needing to know about stable coins or crypto or anything. It's just using stablecoin rails, crypto
Would it
rails.
go into their bank?
You know what? I'm not too sure if it would go direct to bank or if they would need to offboard it from the platform itself.
Because if it could go straight to their bank, then it's a different story. Then they don't need to.
Yeah.
But yeah, if they have to do something extra, they're
It's
gonna
like
be
point of friction, I guess, right?
Get out of here.
anyway.
No, I'm just being honest. I know these people, right? They're like they're old, like they're.
Yeah, as you said, the end flow is the rails is crypto, and then the on ramp, off ramp, you pay fees, you do KYC, you do compliance, because it needs to, like, I think there's like cypherpunk idealism that these systems can replace incumbent systems, but that's totally not the case. Like these technologies need to be adopted on top of existing systems in order to actually like serve the whole world. So we're not gonna be like clicking transactions in MetaMask, but it will be abstracted anyways. But I'm not gonna touch the cord anymore. But this is the breakdown. This is the
price. So I'm on the website. I want to buy something. I can see the price in USD or euro and whatever. And then there is a instant rate conversion. So I can see which converts to any crypto that I hold or I have. Yeah. So then checkout time. I want to buy with crypto. So I see the rate conversion right away. So where do I need a stable coin for that? Because I've been buying with crypto from I have crypto from the get-go. So why do I need a USDT or USDC?
I guess it depends. Like if you're on a centralized exchange or something where you can just directly buy with Canadian dollars, US dollars, then you don't really. But then at the same time, if you're holding funds using a centralized exchange to, just hold your funds, not your keys, not your crypto. I say it kind of memey, but it's pretty true. Then when you move into like on-chain, like decentralized exchanges and such, it's really important to, or at least for me, to price things against a stable value. Like if it's like, I want to buy this much Ethereum with this much other volatile asset, then it's constantly moving, right? Whereas if it's priced against a stable asset, then it's just a little more consistent.
Oh, okay, yeah. So you are basically protecting against volatility.
In a way, like
I mean, that's the only way why I should see a benefit of stablecoin. Besides the protection against volatility, I don't understand the need of that. Besides, unless you want to just save the US dollars.
Yeah.
Because anytime you have a stablecoin, you issue a stablecoin that is not algorithmic. It has to be backed up by dollars, T-bonds, or anything dollar-based. So basically, stablecoins are backing a currency that is losing its value years after years. So that whole thing, I have a hard time wrapping my head around. Because yeah.
You're asking like if I understand the question correctly, it's like philosophical question. It's like, why do we use what is money? But I think there's reality and philosophy. We live in a dollar-denominated world where in order to
but that currency keeps losing its value. So at some point, people say, "Oh, screw that. We're gonna set up blockchain and crypto, so we don't have to rely on something that loses its value day, after years since World War II."
If we're talking about solution to inflation, this is something else. This is like solving inflation is a hard thing, but right now we live in a dollar world, and that's the point of stablecoins. It's a better way to interact with others in this like dollar-denominated financial system.
Yeah, but that denomination could be just a rate conversion on the fly. You don't have to hold a stable coin. You can hold ETH, Bitcoin, Monero, LTC, whatever, and then you have like that rate conversion on the fly instantly, so you can see in your own native, euro.
Yeah, for sure.
So yeah,
but let's look at the reality. Like there's like 300 billion of this, and there's that's what people think it's useful.
Yeah. It is useful because with the Genius Act and the Trump administration, they say, okay, we're gonna just open that, and that's why it's allowed, and now everybody's jumping on that. But it's just like a regulatory opening. Like before the Trump administration, those numbers would not be what they are now if it wasn't for Trump and the new folk at the Fed.
It was still pretty good, but I see your point. But it's like you're questioning the dollar, but
yes,
we're assuming this presentation.
No, the need, because for me the only need of your stable coins is to just save the dollar.
Like, I like dollars.
So yeah, but some want to get some don't want that anymore. Like like China and Russia and let's say Saudi, they want to sell all in yuan or Yes, exactly. Yeah, no, it's not only about dollars. I mean, stable euro is the same. I don't understand the need of stable euro.
I guess.
Yeah.
Let me.
Like you're talking.
Yeah, but you have a mix. That case, buy USDT or USDC, which is unnecessary. Yeah.
Yeah.
The point, just like myself, I don't think you can hold any kind of crypto you want and then just do the swap at the last moment. And so you don't need stable. You don't need to go through stablecoin to access the blockchain. I don't see the need. Oh, because it's $1 one crypto. It's I mean,
Yeah.
yes, yes, yes. I get that. Yeah.
I think we would.
Yes, it is.
Yeah, I don't know. I feel like even like I don't know people in Argentina, the dollar, they're still printing, going away, but compared to inflation there, for them the U.S. dollar is like strong. So I guess maybe for you it wouldn't make sense, but for someone like them, I can understand why they would want stable coins because they want access to the U.S. dollar. Or even like me, where it's like you are right. Like I probably could have just aped into the good coins, and it would have been good. But I also can't handle like full exposure and looking at the volatility every day, and it pains me a little. So I do have my crypto and stuff, but I also like to.
Yeah, but talking about volatility, stablecoin, Terra Luna was a stablecoin, wasn't it? So it crashed.
Let's say like, oh,
So, no, but so that's not a guarantee. It's not
define
I'm a
stablecoin on that.
stablecoin, so no, that's not a guaranteed.
someone died from COVID vaccine. Bad, like, but let's dig into some nuance and let's figure out like, yeah, if- yeah, we can. There's different mechanisms out there. The tech is really good. We can share. Let's try to like dive into what the tech looks like, and you can make your own value judgment whether you think it's something you want to put your money in. But the current market cap is comprised mainly of what you're mentioning, which is these stable coins that are basically representative of short-term treasuries or cash held in the bank. So Tether and Circle issue USDT and USDC respectively. They're having like 200 billion plus market cap. The majority of this is comprised of these two assets, and yeah, it's just T-bills in a bank, and the value is that they're tokenized and they can be interacting with blockchain systems. The third one is Athena, which is like we're gonna get into it, like synthetic dollar representing basis trade, tokenized basis trade, and then below that we have Sky, which is like a crypto-backed dollar collateralized by ETH and whatnot. Anyway, so there's like a huge power law kind of thing going on here where like if you look at the distribution, like the top 5 assets hold the majority of the market cap. So liquidity begets liquidity. There's many reasons for this, but also because the space is very new. And I think like one of the points we're going to highlight here is like we're really early. We're at the frontier, and there's like a lot of innovation going on. So yeah, there's a lot of cool shit that could appear on this list that's not there. But let's move on. So, anyways, like I just kind of explained it, but main 3 categories: fiat-backed stables. They maintain their peg through redeemability. So if I take a USDC, I can go to Circle and be like, yo, give me $1. They're going to give me $1. And that's how this peg is maintained. Asset-backed coins, let's say MakerDAO's SUSDS, it's like over collateralized. So it's backed by Bitcoin or ETH. And let's say for every $200 of Bitcoin, I'm issuing $100 of SUSDS. So it's over collateralized. That's because the collateral is volatile. So you need a buffer. And the peg is enforced via like liquidations, interest rates, redemptions. These are kind of more like tokenized credit. It's like backed by a loan in a sense because you're putting you're borrowing dollars against the collateral to mint this coin. And then the third one, like Athena, it's tokenized strategy. So you give some dude $1, they're gonna do something with that dollar, and they're giving you a receipt. That's the stablecoin. The receipt represents a claim to $1 worth of principal in this strategy, plus whatever yield that $1 generates. So I give $1 to Will. Will does arbitrary yield strategy. He turns it into $2. And so now my claim, like my receipt, I get my $1 principal back plus $1 of yield. And the reason why it's cool is because, like, let's say you have a T-bill in traditional finance. You can't do anything with it. It's stuck in the bank. But here, I can take the T-bill, I can collateralize it, I can borrow against it, I can split the yield into PTYT, like through Pendle, which is like kind of, we'll get into it, but tokenization enables composability and collateralization, which is like pretty cool in my opinion. So the differences between these coins are evident in how they're created, and like there's a kind of concept in the community which is like trilemma. Fiat-backed stables are super centralized. Like you're trusting someone to custody money in a bank for you, and you're trusting someone to issue a coin and honor redeemability, which is like really centralized. But it's really good peg. Like you look at the peg, it's like really tight, and peg meaning how closely it trades to a dollar, and it's really capital efficient. $1 in the bank, 1 USDC. Whereas like a decentralized stablecoin, maybe it's like backed by crypto, managed via smart contracts, but the peg is weaker, and you need more money to create $1 versus alternatives. Yeah, that's kind of the dilemma.
Yeah. I don't know. Kind of touching on that when you say, not all stable coins are created equal. Feel like, there's positives and negatives to each of these, right? As you were saying, peg on the fiat backed ones, super solid, centralized. Asset backed ones like CDPs with Sky, USD, whatever. They're less capital efficient, but they're decentralized, super cool. Tokenized strategies like with Athena, USDE, USDE, also, in my opinion, really cool, but they also come with their own risks, whether that's, execution of the strategy, if there's like execution of the strategy, funding rates, flipping negative. It's a strategy,
Trust
right?
me, bro.
Yeah,
And it's not really a dollar, but it's like really cool.
Yeah, it's close to $1 most of the time.
Yeah, we'll get into it. I think so. Examples, just so you like, just to drive it home. I think everyone kind of gets it, but these are some examples if you want to check it out at home. I wanted to pull up. So I think fiat-backed stables and asset-backed stable is kind of like already been there, done that last cycle. Like the tech is kind of built. We know how they work. They're kind of in like the growth phase. But like where the innovation is happening this cycle is in like tokenized strategies and like yield-bearing stable coins. And it's called yield-bearing stablecoin. It's kind of like as a friendly name, but in reality, it represents $1 in a hedge fund essentially. So kind of not really a dollar, but that's where a lot of the innovation is happening, and a lot of like the opportunity for yield is this cycle, in our humble opinions. So let's take a look at like what we mean by that from data. So StableWatch, great dashboard to monitor yield-bearing stablecoins specifically. So they have like this statistic, like it shows how much actual real yield is paid out by the top yield-bearing stablecoins. So yield-bearing stablecoin kind of means like for example, let's try to see SUSDE. It's not actually worth $1. It's a dollar-denominated product that's like represents the dollar plus the yield. So typically they're like, if they're working properly, they're worth more than $1. Like SUSD is like $1.20, and it will continue to go up in value based on the yield that it accrues. So let's look at you can see like the top yield-bearing stablecoins here. SUSD is like the killer from this cycle. It's at like 1.5 billion. Maybe this is outdated. Maybe
Yeah.
Yeah, there we go. So yeah, SUSD is like 13 billion. There's like Sky, which is MakerDAO, BlackRock, Biddle, Syrup USDC. So these are like each doing their own strategy. You give them money, they do something else, like something else with it. Supposed to be like within like a scope of things. So I go to Athena, I know they're doing basis trade. I go to Sky, I know they're doing lending. I go to Biddle, they're doing T-bills. Syrup is doing private credit. We know what they're doing, and they're gonna pay me yield because of that. And me as the user, it's like, do I want exposure to basis yield, or do I want exposure to lending yield, or do I want exposure to private credit yield? That's like the choice I make when I allocate capital to these different coins. And I will show you like interesting things. So these guys have pretty good like data hygiene. Like they're tracking real yield, not like any points, token emissions. But like you can see, like this is kind of crazy. So imagine you have dollars in the bank and you parked it in the bank and it's earning ranging from 4.7% to 16%. And then you can swap it out and spend it when you want to spend your money. So like imagine your RBC e-transfer account has like yield like this. So that's kind of like the vision for these coins. But of course, there's much more under the hood about like the risk involved. But yeah, man, I think that's pretty cool. Like you have that's pretty high yield just for one click and dollar denominated.
Yeah, I'd say so. And as you were saying, it's just they're all so different. Like you see up there Edge, that's Midas, I think I'm saying that right, tokenized funds essentially, where essentially I think now they have probably like 10 or 15 different hedge funds, curators of such that they take your money and then they put it into their strategy. A lot of these aren't promised to stay at $1. They are a little more true to, hey, you are buying into a strategy rather than a true stable coin. But I think it's also about like the opportunity, right? Like if I were to go to, I don't know, whatever hedge fund right now, as I am right now, it's like, are you accredited? How much money do you have? KYC. It's a walled garden, right? It's rich people to get wealthy type thing. But on crypto, DeFi, anyone can access these strategies really easily.
Okay, so funny, like let's paint a picture. So like let's say there's like an Afghanistan woman. She can't use bank, and then she somehow like stumbles upon like $1,000, and then she apes the $1,000 into like 20% APY strategy, and then now she has like, I don't know, that yield being paid out there that she can go do shit with. Everyone in the town is gonna be like, oh my god, like where do you get that money from? It's like huge power up.
Yeah,
If that's maybe a bad example, but
my Afghan man.
No, because in Afghanistan, women can't use bank. I've heard.
My bad. That was a good example then.
Yeah. Or no, Indonesian airdrop farmer. So the Indonesian airdrop farmer gets the Monad airdrop. He like gets like, I don't know, let's say like 10K, and then he puts that into yield strategy, and he can maybe like buy one meal a day from the yield for the year. Like that's pretty insane.
Yeah.
Like we did that with our treasury, low key, like to pay like we paid a designer for a full year just from yield. So that's pretty. That's pretty.
That's
bullish.
tight. I'm with it.
Okay, so yield is cool, but yield is a minority of the stablecoin market cap. Like most of it is for payments, but you can see the yield varying stablecoin, the yellow line slowly growing. Okay, we talked about why it's cool, but it's also like, and we talked about some of the types of yield. I think probably a bit much to get into, but it's the same in finance. Well, like how do you earn yield? You earn yield off spread or fees from trading, which is like LPing. You earn yield from lending, like interest. You earn yield from like complicated strategies, like delta neutral hedging stuff. And you can earn yield from like, so these are all on chain, which is good because you can verify all of the different things that are going on. Like I don't have to trust that he's doing a delta neutral strategy on Hyperliquid because I can see it on the Block Explorer. But then there's also off-chain yield, which is also like split in its own ways, where like USDAI is like hot recently. I don't know if you guys have heard of it, but it's like taking in stablecoin deposits, lending it out to people who want to finance GPUs, and then because like right now AI supercycle or whatever, and the people who buy the GPUs run a business, they earn revenue, they pay back the loan, and plus interest, which is passed on to the stablecoin depositors. So you're earning yield based on like the hotness of the GPU financing market, and like it's off chain, but you can build it in a way that's like as verifiable as possible, whatever. So off chain yield is a potential source of yield. Did you want to touch on anything?
Yeah. I guess, yeah, again, for Maple or USDAI, it's just, for me, average person, just another way to access, financial instruments that aren't available traditionally. Right? Like, I couldn't myself finance, some data center, whatever, with, USDI, Maple. They can pool money from crypto users. They have all the, depending who they are, correct checks, KYB, etc. They do the due diligence, own risks in that. But yeah, it's just great to have another access point to different financial instruments.
Agree. Okay, this is like the most probably important slide. Like, if you look at like, so there's these guys in crypto called like, or in DeFi ecosystem called like market neutral funds, market neutral farmers. They try to like earn as much dollar denominated yield without taking any directional exposure to the market. And what they're really good at is pricing risk. Like, is the APY I'm getting worth the risk of what's actually being done with my money? And that's like the whole question here when it comes to yield. It's like quantifying the risk uh, that the money is being subject to, and then is the yield I'm getting back worth it? So what are some different kinds of risks? Custody risk. So like, if it's an off-chain solution, if it's an off-chain yield source, you're giving money to someone and trusting that they're like custodying it safely. Principal agent risk. If you're giving money to Athena, you're trusting that they're gonna like hedge their delta neutral position properly. It's not something you have visibility nor control over. Principal agent is like any time you need to trust the middleman. So even if it's someone like rebalancing an LP position in a DEX for me, like, oh, I put money into Will's vault and Will provides concentrated liquidity on like a on a pair. Like, we're trusting him that he's gonna do that liquidity provisioning properly. Sometimes these coins take deposits and do like things that are not dollar denominated. So like they'll hold Bitcoin, but maybe they'll short Bitcoin, so it's still delta neutral, but you could be exposed to like Bitcoin volatility if the hedging messes up. Smart contract risk and hack. So I hear like farmers talking like, oh, if I'm going to a new chain, let's say Unichain, it's a new chain, reputable team, I need at least 1 or 2% extra APY just for bridging to a new chain. It doesn't have Lindy, it doesn't have yeah, it's not been battle tested, so maybe it's been audited, but there's a risk that the money goes to zero. And to be compensated for that risk, I need 1 or 2 extra percent than I would on the same strategy on another chain. And then the last thing is secondary liquidity. So we talked about redeemability. Most of these coins, you can like go to them and say, yo, give me my money back, and they're gonna redeem from the reserve. But what's another way to get out of a coin? It's like swapping it on like a DEX or any kind of exchange. And that's like let's say like redemptions have a duration. Like, let's say there's like a 3-day withdrawal queue, but everyone's trying to get out. If you want to get out right now, you're gonna sell this coin for another coin on Curve or something. But the depth of secondary liquidity is also a risk. Like, if you need to get out quickly, how much liquidity is there for me to swap into? If something bad is happening, everyone's gonna be fighting to swap, and that's gonna incur slippage. And like, these are like the big brain considerations these guys consider.
Yeah. I guess one other thing when we're talking about risk is, great thing on chain, or even just like places that are pretty transparent but doing off chain stuff. You can see everything. You can see the trades, what's going on. You can verify. Not a lot of people do that, to be honest. Everyone just apes. They see big APY. They don't read the documents. They're like, that sounds good. That sounds great. And then something might get a little cooked, and it's like, what happened, bruh? There's just, it's when you're opening up these walled garden financial instruments to everyone, that's great, right? More access for everyone. But when you're trying them, you also need to like do your own due diligence. Like, if you don't fully understand it and it looks really great, I'd probably just hold off for a bit, read a lot into it. There's a lot of great yield products that also are really high risk. And, for me, I can take as much risk as long as I understand what it is. Unknown risks will just cook you because you have no idea what's going on. If you know what the risks are, you can monitor for it. If something, you can kind of maybe not predict, but you know what's going on at least.
Questions? Yeah. That's the hard part. So these, so there's some like, the incentive is not aligned towards making the risk transparent for the user whatsoever. If I want, like it's up to the project to pay money to do like, to allocate resources to make like a nice risk report and do all these things transparently. And like projects cannot really get too big without all of these nice transparent documentation, but there's no like standard. So it's really just up to you to do your own digging.
I guess there's like Chaos Labs, Chainlink. They do reserve checking for USDE. But in terms of like how you find out, I'd say just honestly a lot of research through the documentation, like Athena, basis trade. You might not have exposure to the underlying price movements of what composes the strategy, but what do you have exposure to? The funding rates, which you want because that's where the yield is from. But funding rates aren't infinitely up, right? Funding rates can go negative, and that just incurs a loss to your position. So then you're losing yield in that sense. You're losing value. So yeah, even market neutral positions have their own exposures. So yeah, honestly, just a lot of reading, bro.
So
Yeah.
the stable watch is good. So I want to clarify my point earlier. Like like if you're really trying to like make your project big, you're gonna have some sort of risk thing. But it's often like the project has information asymmetry. They know what they're doing, and you don't know what they're doing. So I can paint a very nice picture about what I'm doing, but leave out a few details that's where the actual risk lies. So anyway, stable watch, this website, they have like some basic rundown. And like usually if something is pretty big and like a lot of people use it, like, that's like a okay heuristic. But you said Terra Luna, that's
Yeah, that's what I was just gonna ask about.
So-
Did you guys have money in it?
personally no.
Terra, you didn't? That's me.
I personally did you?
No, but I watched it all happen.
I've
'Cause how
done-
transparent do you think that was when it happened? Because it was pretty big. Like, how do you think people were vetting that? Because it's a good example of
It was
what
just
you're
like,
saying.
maybe I'm wrong here, but was it just like, this is cool experimentation, DeFi? Like,
People
did
knew
Well,
about-
the APY was insane.
Yeah, people called it though because they under like if you look into how does this thing work and where does the yield come from, you saw that it was like I can't confidently walk through the mechanism, but it was something where it's like the yield is from this governance token, but the governance token is also used as collateral, and the team has full control over like the backing of the coin or whatever. These are things that were verifiable on chain, and people were calling out. But also, industry was more retarded last cycle.
Yeah,
like,
definitely.
and then they need to be whipped to like learn to not be retarded. Like
I have a really good podcast I'll send you actually. It's like Suzu is talking about how like in 2020, I guess it's 2020, it's 2022, yeah. With what happened with FTT and like with Arrows Capital, like he was kind of saying like I guess there's a pretty big debate about like if SPF fully should be like
yeah.
in as much trouble because he recouped all the money. And I think people were saying that like if this was in a traditional market, they would get bailed out, all these companies that kind of went under. But they're doing kind of nefarious things. Like obviously what Do Kwon did too was like sketchy shit. I kind of forget the specifics as to what he did that made everything go to shit.
I don't think we know, right? Like This is always
yeah,
on?
get close to it, man.
I think it's on.
Yeah.
I don't think we
Good to
know
know
the
it.
specifics, right? Like it's probably
Mm.
before the courts in Korea.
Yeah.
But to answer the question about the risk, right? The yield is your biggest indicator of the risk because there's smarter market participants than you. And if they don't want the yield, what do they know that you don't know, right? So it's basically like there's no free lunch,
Mm.
right? It's either not a lot of liquidity, it's risky, It's like you said, it doesn't have a lot of Lindy, like it's brand new, so no one. So that's you. I mean, I'm not a financial advisor, but you have to like layer these things, right? And like understand that you can't put your whole portfolio in the 20% APY one.
Cover or go into like some of the products that you
Yes. So that's the next part. But real quick, so this research question is a good question. Like last cycle, so Athena is like the supposed like, oh my god, it's gonna end this cycle. It's like the most popular yield bearing stablecoin this cycle. Everyone was like flooding it.
Black
And
Swan.
Black Swan.
yeah.
But now they have a really robust like to combat that because they're actually legit. They're like I believe that they're good actors and they're like trying their best and they're like hella like really sophisticated. Like they have all of these data publicly available about like what they're doing. Who knows? Like you could probably dig whether like it's verifiable or not, how trustworthy this data is. But there's a lot of work being done in the industry push towards transparency because like that's one of the core ethos of the industry, and that's one example. I think
For Athena, it's like they have like 3 or 4 third parties. Some of them have access to like the Copper or Sifu hold custody accounts, and then they pull that data. Then another third party verifies that. Then Chainlink takes that and graphs everything out. It's not to say it couldn't. Nothing's ever perfect, but yeah, I think they're doing a lot to be as transparent as possible.
I think, and then to the point about like the crazy APY, like if you don't know what the yield is, you are the yield. This kind of heuristic, it checks out. But I just wanted to show like a pretty like if you look at so HLP is like a vault that takes USDC and market makes like perps DEX called Hyperliquid, and you can see Hyperliquid is like a exchange where you can do leverage position, but it's all verifiable on chain. So we can actually see what positions this vault is taking, despite this vault allocating the money in like a black box fashion where you don't know what they're going to do next, but you can at least see where it currently is. And this thing printed 100% APY in the last month. I mean, 100% APY, was the last month's average APY, which is like, of course, last month is like a crazy month, but there is high yields out there if you're trenching, and this is on 500 million. It's not like this is not chump change. So anyways,
Yeah,
that's
at the same. I think it's also important to know it's like this isn't 101%. Like these aren't linear returns. You can't deposit and expect to start earning 100% right away. I would like a big portion of that, I believe, was due to like the flash crash that we have, all the liquidations that happened. So yeah,
This
yeah.
and yeah, so it's there's nuance to it, and this is like not 100% in a month. This is 100% annualized based on the last month's return. So, anyways, but there's some crazy shit out there. Okay, I wanted to pause just to see if there's like questions about types of stablecoins, what people use them for, risk profiles, and then we can like take you through like a DeFi, like yield farming step by step kind of thing. There's no questions. Okay.
particularly with conversions from currencies. So, obviously it's a big 3-4% currency change if you're just going to the bank or whatnot. But if you were to go through one of the mechanisms you've suggested, is there a comparable currency exchange? So let's say I want to change dollars. Say I want to change. Suppose I want to change Canadian dollars to euros. If I were to take it to the bank, I'd get an exchange rate, let's say, of 1.6. If I went through a stable coin, is there a benefit in the sense that there's not an in-out on each side as big, or do you have a comment on that at all?
Yeah, so there's these like decentralized liquidity pools, like many different venues like Curve, Uniswap, whatever, and they let you create like a pool where you can swap 2 different assets. And then there's aggregators that route your transactions across all these pools and find you the best route. So I was trying to find like a euro to USD pool just to show you, but let's try it on CowSwap, which is like an aggregator.
CowSwap's super cool.
So
CowSwap. Ooh, oh, it moves when you make a
they
transaction.
have euros.
Okay.
So 1 million euros is going to get you one. Let's compare this to so it's not.
Yeah,
Yeah.
you're off by 1%.
Yeah.
Also, though, like, let's say you were to use a crypto credit card like EtherFi. Do you know what their exchange rate is? Like, if you're buying something here in Canada, you're paying in CAD at the end of the day. What's your exchange rate that you're paying?
I dox my transactions to check.
Yeah, yeah. I know for quite a few of those for USD, like from crypto to USD, it's 0 for a lot. But good question for actually, Canada, elsewhere.
EtherFi Cash, but wait, sir, I'll show you my referral code. No, for real, you'll get something, and I'll get something. But yeah. So, anyways, this is an example of the swap that you asked, sir. So I don't know. What did you say your fee was when you did euro to CAD? It really varies. So here you can get 1% on size. Yeah, 1 million.
And it'll depend like what chain, what pair too. I guess if it's aggregate, it might be different.
This French gentleman's question is that too many times for particularly say Canadian dollars plus American dollar, there's a double exchange done. So for probably 99% of the credit cards around the world, if you go to a different country than the United States with a Canadian credit card, they'll buy say something in Costa Rican pesos. The credit card converts it to US dollars first, so you pay let's say a 2% exchange fee there. Then they convert it to Canadian dollars and you pay another 2% there. There are some credit cards, if you travel a lot, you should really get that go directly from the foreign currency of Canadian dollar and save you 2%. But that was the reason for my question. Is that's a definite use case, of the crypto. I'm going to say stablecoin.
Yeah.
That's how Revolut did the market, right? Multi-currency cards.
I'm sorry.
Revolut app in the UK.
Revolut.
Yeah. Yeah. I have, in Canada, I have a credit card from HT Trust.
Okay.
And it's, again, not double conversions.
EtherFi seems to have pretty okay conversion, but not.
Exchange rate at the US dollar there on the Google side, because that's the, I'm going to say, traded rate.
Yeah, this is the traded rate. This is like
So if you
less
buy,
fees.
if you buy, you pay a little bit more. If you sell, you get a little bit less.
Yeah.
Yeah.
So
So
let's go ahead.
there's bips around that. That might be the interbank rate. So you could say
They could be depending on the provider. So with Wise does it a bit differently. So some people have liquidity on both sides in countries, so they'll directly transfer based on mid-market plus some spread. But with crypto, it depends on the pool. So pool will have some liquidity. So maybe like in this pool, there is 10 million at that mid-market price, whatever that is. So we can swap a high amount. So if you do like 10K there, you'd probably have less than 10 bips on the spread. So you can check the rate. It's pretty competitive.
The EtherFi Cash has a good conversion rate too. I just bought a Eurobus. I was just checking, but yeah, this is like I'm always saying, there's fees on top of this. So this is Base has better liquidity than Mainnet.
Mainnet was 0.78, I think, and Base is 16.16.
Yeah, this is pretty good. Like this is, let's try 10 million.
Look it up.
Okay, then it gets pretty bad. Yeah, this is crazy.
Oh, you actually are positive.
There's a liquidity pool behind that.
yeah, just Euro and USD in that liquidity pool.
And is that algorithmically traded?
Yeah.
So that's the AMM part. Like it automatically manages liquidity on a curve.
Let's show you. So this is like this is the main decentralized liquidity DEX thing on Base. Coinbase's chain, and um, it's likely, like I will guess, like it's likely where CowSwap is routing this order through. CowSwap is like it uses solvers. It's like really cool. It's like it lets people come to bid to do this trade. Whoever finds the best execution can like get the right to do this trade, and then they can take some fee on it. So Aerodrome is where the pool would live. It's not loading, but it's we can see how much liquidity is in that pool basically if this loads. Anyways, think it's bigger. Is there any more questions?
Aspect of yield farming.
I think so. There's a statistic. There was a chart we showed all the different types of yield, and liquidity pool is the worst yield. Like most retail, 90% of retail liquidity providers get rinsed on their liquidity provisioning because the APY you get is like you need to. It's minus a permanent loss and LVR, loss versus rebalancing. It's like some math shit, but basically like there's smarter guys out there, and they're just taking your money, and then you're just like cooked. That's essentially what it is, because like it's like you wouldn't trust your mom to do market make for you. So why would you? I don't know how to market make. So I'm not gonna provide. Like yeah, liquidity provisioning is like pretty poor unless you know what you're doing or you're farming points or something like that. But we'll talk about some other yield stuff that is like more 1 or 2 click and like you actually make money. But yeah, it's interesting. The old school last cycle crypto, everyone was LPing like volatile tokens, and yeah, and then you kind of make money if you like print on like the emissions. Like dexes would like emit their governance token, like AKA their stock, and like incentivize you to provide liquidity with like their stock. But then like that stock token would be like worthless eventually. And
No, I kind of like B2 LPing, but once it got into like concentrated LPing, then I low key checked out, bro. It got pretty confusing.
What is the concentrated LP?
Yeah. Are you are you familiar with this, bro? I
this
don't
is
know
like
if I'm
smart people shit, but
yeah.
I'll show you what it looks like.
Like, if I'm not mistaken, V2 is like you're providing liquidity to the full range with only a certain portion active earning yield. That's all automatic. Whereas concentrated liquidity is you are setting your own range and you have to manually set that range. And if you go out of range, you need to rebalance. And it's way more active. It can be way higher yield because all of your size is in this range, all of its earning yield in the range, but it's just really complicated and costs to rebalance, swap, all that. Yeah.
So you lose money in your platform on that?
Yep, definitely. I've tried and then I decided not to.
How long did you play with it?
Probably a few months. I feel like LPing is something that when you're getting into DeFi, you usually try. Then you even get into stuff where it's like you can go to Beefy or whatever and they automate the range and such. But there's just so many, in my opinion, so many better options to earn yield. But LPs are kind of the backbone of trading and everything, so it's necessary, but not for me.
there's like a thing we talk about, like who are all these LPs LPing all these coins if everyone's losing money? Like there's obviously sophisticated people coming in here, but yeah, that's so true. That's so true.
But it's like what you said, like there's no point in LPing because I shouldn't say there's no point, but you're playing against people. You're playing against it's PvP and you're playing against like bots and finance bros, right? So do you think you can beat like someone who has a PhD in math? No.
His name is Jang.
It's the same as day trading, right? Like 90% of day traders lose money because like, but it's tempting as shit, right? Because it looks real fun. Like, look at how fun that interface is. Like that's why we've all tried it because it.
And
right?
the-
And who doesn't want to like?
You
Who
have some
doesn't want to like be the bank or like be the exchange?
you have
right?
some cool stuff now with like yield basis or gamma swap, who essentially are offering products that I don't know how successfully, but attempt to mitigate impermanent loss through either leveraged LPing to try and make more yield than you're losing on that, or using options to I don't know.
But
options,
doesn't like the
yeah,
strategy
whatever.
thing make more sense? Maybe like
yeah,
where there's a group of smart people out there somewhere, and you're giving them your money to do it for you. Basically, is a strategy, right?
yeah.
Yeah. Yeah.
Wait, do you have any thoughts on liquid LPing, sir?
So first you talked about impermanent loss and rebalancing, but if you have stablecoin, you don't have money.
Yeah.
There's 2 or 3 stablecoin, so you are not losing money.
You're chill.
And the second point with concentrate liquidity is you, even with Uniswap v4, you can parameters if you go out of this liquidity, for example, convert to stablecoin. So you can protect yourself with liquidity. Stay in range. If you go out of this range, you do whatever you want, like into stablecoin, for example. And since you can be really concentrate, you can really make a lot of fees into a specific range and not be fucked by
IL.
AI.
So if you know, for example, there's a pool that is like stablecoin and stablecoin. It's both $1. You know that the exchange rate between these coins is going to be around 1-to-1. You can only choose to provide liquidity. That's the whole point of concentrated liquidity, where it concentrates the liquidity around a price that you think is fair, and it helps and it removes liquid. You have no exposure if it goes outside the range, but
Like stable pairs, like you can even do like WBTC, CBBTC,
any correlated
like
assets,
that.
that's more chill.
Yeah.
It's more chill, but yeah, that's facts. More chill.
Yeah, for real, bro.
What do you think of like convex and stuff and like the curve wars?
So
What are your thoughts, man?
So I just had I launched a stablecoin. We have like and we've been doing the whole bribing thing. So he's asking a question about like how do these guys get this much liquidity? Like let's say this pool CRV USD USDC has $46 million of money in it. How did they get it here? It's by offering like pretty good APY to people to provide liquidity into this pool. How do you get this APY? On different dexes, there's different like games you can play. So on Curve, it's like you bribe VE CRV stakers to vote for your pool to increase your pool's boost factor, which allows the LPs to earn more CRV rewards. It's like hella complicated, but that's the backbone of DeFi. Like if you're launching a stablecoin, you need to know this shit. So like, that's what I think of it. It's useful. It's a necessary evil.
Yeah, because I think when I got out of DeFi in like 2022, it just became too much. Because all the governance stuff got so confusing. If you can comment on that at all.
Yeah, like
there's so much nuance and like you know Dave Lebowitz, right?
The name is familiar, but
I just feel like that stuff became way too galaxy brain. Like I feel like I've never understood Curve that well.
I think there's 5 people in the world who actually know how it works properly. Like as someone who bribes on Convex and Staked Out, like I'm talking to Staked Out guys like, please sir, like what does this mean? Like can you help? Because they know what it is, and then their job is to like tell you what to do properly. But there's like layers of abstraction above it. But I think it's not. Let's see. I can show you one of the pools that's like. This is one of our pools. So it's a quad pool. It's like 4 different stablecoins, and this is like the stablecoin we issue. And like you can see that since we are bribing CRV voters to vote for our pool, you can earn 28% APY by denominated in CRV by LPing to this pool. So yeah, it's not bad because we pay cash. We bribe people to the whole little system, but
So the CRV is directly unlocked. The yield that you
yeah, the
earn?
yield you earn is directly unlocked.
Oh.
That's like the Curve game.
And why your coin is 0.98, for example?
It's because people have been selling it, sir. Yeah, I can talk about a lot
cheap,
about my own
cheap.
problems, but yeah, it's cheap, guys. I think I think if you guys are looking for a dollar, if you can buy, if you buy it at 98 cents, that's a bargain. But like like FEUSD, like it's the same mechanism, and there's like a redemption fee, and the redemption fee eats into the redeemer's profit, and that makes it so that it's never perfectly pegged. And there's like a whole nuance to it. But anyways, this is our little pool. Since you were curious, I think it has it has like it went down a bit, but it like has like 600K in it. So if you wanted to swap my stablecoin for, let's say Bull, let's say you wanted to swap it to USDC, CowSwap would probably route you through this pool. So it would like buy EBUSD to Bold and then Bold to USDC. It would find the lowest slippage path, and then it would get you like maybe 98 or like 97 USDC for 100 EBUSD. Okay, we talked too much about LPing. Let's talk about better stuff. So here's like you have anything to say?
No, let's get out of the LPA, man.
Yeah. So this is Athena. So here's like a classic flow. So let's go to Athena. Let's say I have some dollars. I want to earn like some crazy yield, but still safe. So I go to Athena and I say I want to. How do I mint? I go from. I want to mint. Take swap. Okay, I guess I can swap into it. So I can go from USDT to USDE. So first I have USDT. Now I swap it to USDE. So let's say I do like 1. I'm going to get 1 point whatever USDE. Cool. Now I stake it. So USD is $1. A lot of these stablecoins have two versions, a non-staked and a staked version. So the non-staked version, you can think of it as like a deposit. It deposits money into a trade. And the staked version earns all the yield from all the money in the trade. So
it's kind of levered up, right? Because technically both are earning yield, pushing it to the stake pool or whatever, but only those who officially stake are receiving that yield, not like USDE holders. So it's amplified. Yeah.
This is like a game that emerged this cycle. But anyways, 1 USD, you're gonna get like one little bit of SUSD. Now what you're gonna do with this? And this earns right now it's earning 4% APY. So right now it's in T-bills because no one is longing right now. So this earns yield, more yield if more people do leverage long on perps. That's like the way Athena works. And right now everyone is scared because they lost all their money 2 weeks ago. So no one is doing leverage long, so the yield is low. But historically, this yield was can range to like double digits APYs. Now what we do, we take this, we go to Aave. Aave is like the most blue chip lending and borrowing protocol. It's like a money market.
How much TVL does it have right now, bro?
50 billion, right?
Something crypto like
50
that.
billion. It's the biggest, number one protocol. What?
37.
37.
Only 37 billion.
Because crypto went down.
True.
Pardon? It double counts? Okay, so 50 was kind of right. But so you take this, you put it into Aave. So what is Aave? It lets you put crypto as collateral and borrow other stuff. So I would put SUSDE as collateral, and then I would go into E mode first of all. Like E mode just basically lets you borrow at a better LTV. You can read the docs what it does. You put SUSD as collateral, you would borrow, let's say well, it's not showing, but you would borrow USDT or USDC. I would put SUSD as collateral. I would borrow USDT. I would use the USDT to buy more SUSDE, deposit it as collateral, borrow more USDT, and then do this recursive loop. So what I'm doing is I'm increasing my exposure to Athena's yield by borrowing dollars and buying more without increasing my liquidation risk too much. Like, what's the risk when you borrow? The risk is that collateral goes down, and then your loan to value gets too low, and then they take your collateral, and then you're just like, you lost money because it's over collateralized, you get haircut. But since you're borrowing a dollar against a dollar, you're not really having liquidation risk. Like if the dollar appreciates, they both appreciate. If the dollar depreciates, they both depreciate.
I guess the risk would be the rates here. Like if the borrow rates start to exceed the yield, then your LTV can get a little cooked.
This is a bad UI. I'll show you a better UI. So this is a borrowing protocol, and it actually just shows you like what leverage looping looks like a bit easier. Damn, why isn't that? Wonder who did. Oh, actually, sorry, we have a
Docs deal.
docs. Damn, no money. I think I can show it without connecting the wallet. Because we have actually the known issue, guys. This wallet has fucked up.
So what is the lore behind Ibisu too? I don't actually know much about it.
It's the god of fishing and wealth.
Okay.
I like fish and wealth. Sorry, yeah. Okay, so let's say we have SUSDE, which is like the yield-bearing coin we just saw. If I wanted to like lever it up, I could deposit as collateral and recursively borrow. And this recursive borrowing would increase my collateral exposure while not incurring liquidation risk. And if like Will said, if the yield from the collateral is greater than the borrow rate, I'm chilling. I'm earning positive carry. So like, let's say I have like 1,000 SUSDE worth 1.2K. I want to like lever it up, which like on the back end, it automatically does that thing I just said where like I'm borrowing EBUSD, buying SUSD, borrowing, buying, redepositing up to 6x. Now I have like notional collateral exposure of 6,000. So I started with 1,000, but I've levered it up 6.3 times, getting haircut a little bit each time to the point where now I have 6,000 exposure. So imagine 1,000 yielding 10%. Now I have 6,000 yielding 10%, but I only put 1,000 in. And I'm paying interest, but if the interest is, let's say, lower than the yield is 4, the interest is 5, I profit 1% each loop. So 1% times 6.3. And like, this is like a bad, like when Athena was yielding like 10% and I pay 3%, it's 4 times 6, which is like 24%. Like that's pretty lit. This is the concept of leverage looping. So yeah, that's one way to earn yield. Let's go to other ways.
What is the risk of leveraging stablecoin?
Main risk is 2 risks. The rate going, so negative carry. If you ever have to pay more borrow rate than you are earning yield, then the borrow rate eats into your yield. So let's say I have $1,000, it's earning 10%, but I have to pay 20% to borrow. So then like I'm losing money. The second risk is collateral depeg. So the system's job is to make sure that that any loan it issues is always backed by more collateral than the debt. Because these systems are like, they're all over collateralized, mostly. So let's say Athena, which is pegged at $1, depegs to 50 cents. If you have like a good risk system, it's gonna liquidate you. Even though you're not supposed to be liquidated because it's $1 and $1, but like let's say Athena gets hacked, or let's say so many people are selling Athena on the open market, the Oracle price goes down. So these are the 2 risks: negative carry and collateral liquidation. A collateral liquidation due to depeg.
Yeah, I feel like then you can get in some fun conversations where it's how are these prices implemented into the different markets. Like there are some cases where as long as Athena is always redeemable for $1, even if secondary liquidity gets cooked, it's trading at 40 cents, they've hard coded it to the $1, right? So you won't get liquidated. Kind of makes sense, but there's obviously some trade-offs for that.
Like one of the hidden risks we talked about, like how are they actually computing the price for the collateral? Like Will said, like Aave has made the strategic decision to hard code Athena USDE as at $1 because they trust it and they have like many people scrutinizing it. Like the protocol I'm building, for example, we actually use the market rate for SUSDE based on the aggregate of its price across its biggest DEX pools. And like we chose that because like we're like a small team. We're not that always. Yeah, we have less resources, and we want to use the power of the market as like a source of truth. Like market, if Athena something bad is happening, people will start selling it on DEXs, and that's an early indicator to our system to start liquidating this collateral. The downside is, what happens if it's just like a day like Friday, everyone's selling because they're panicked. Nothing is actually wrong with the solvency of Athena. Then users on on a platform using the market rate would get liquidated, even though nothing is wrong. So there's like trade-offs. Like one, I think that's actually one of the most important risks in DeFi, like Oracle risk. We've been talking for a long time too.
Yeah, has it been a moment, bro?
Yeah, I think so.
I've been chilling, dog. My bad, guys.
Last thing. So, anyways, that was looping. There's yield vaults. We talked about Midas. There's like Veda, whatever. This is a bit more like you trust the curator. So, like Edge Capital is one of the biggest on-chain hedge funds. You trust them. 25 million have trusted them to earn them 25% APY. What are they doing? I don't know if there's transparency.
Wait, little down, bro. Little
here.
up. Well, wait, never mind. No, you're right. Yeah.
Yeah, so right now they're doing some plume farming. They're like doing this 0G farming. You can see what wallets they have. So there is some transparency, but it's there's no standard. And then, like we said, this is a tokenized hedge fund. So when you deposit, you get 1 M syrup USDP. You can take that to like borrowing market like Euler, which is more like long tail, and you can loop. So the whole thing I just described of like looping SUSDE, you can like loop these like M Apollo. So one of these vaults is like M Apollo. It's right here.
17%
APY. Who knows what they're doing? Let's see what they're doing.
Who knows what they're doing, but 17%, then you can loop that against like 4 or 5% borrow rate, bro.
So they're doing something on Ethereum with USDC. But then let's say we want to like leverage it up 5-10 times. Well, now we can get 170% APY minus the borrow cost, and maybe it's like 60%. That's like really nice. But it depends what they're doing. Okay, the last thing I wanted to talk about is like for like the doomers. I did it. So all of this recursive looping is really good, like for borrowers who are like eating well off the yield. But there's like it's really important to understand like this crypto thing is really small. There's only a certain amount of money. That money is like, you need to really know what, like a macro view of what's going on in the ecosystem. I want to, so there's this thing I found this weekend, which is like AUSDC represents USDC lent into Aave. And if you look at the biggest lender on Aave, it's Athena. Athena, the protocol we just talked about, lends 700 million USDC to Aave, representing 14% of all the USDC lent on Aave. And we just do some like logic real quick. Like, are they that rich? Yeah, they're doing pretty good, but I don't think they have this much cash in their treasury. So where does this money come from? Like obviously like users' deposits, right? So let's say you deposit into Aave, to Athena. Their basis thing isn't cooking right now because no one's longing. They're just shoving it into like all these low risk strategies just to generate a measly 4%. And then if you look at the biggest thing that's happening on Aave, it's looping derivatives of Athena with USDC. So this PT SUSDE, this is like the hottest strategy in DeFi right now, like looping these Athena PTs. And like this much collateral PT has been supplied. But this PT collateral is minted using like the deposits that minted that PT collateral is being lent against that PT collateral in Aave by Athena. So there's some like circle sucking going on here. That's like, I view it as a little bit systemically risky.
Do we have the elephant
And
meme?
there's like the elephant.
Yeah.
We can edit that. You can do the close.
Okay, bet. Yeah, I guess. Shit, bro. I don't know what to do for closing remarks. Yeah, it's pretty much like that, bro. You're giving them money, they're putting your money over there, but then you're taking your receipt of the strategy they're doing and putting it on Av, and then you're borrowing the money that you already gave them with the receipt that, you know what I mean? Yeah, it's kind of like the elephant. Yeah. I'm just yapping, bro. My bad. Any questions, y'all?
Thank you very much. That was very informative. Thank you. And let's say like with all those strategies, you make a lot of money this year, and you have like 100K profit. How much tax you gonna pay on that? Yeah, no, because all of that is KYC, so we gotta talk about tax. You cannot avoid it.
I mean, yeah, yeah. So you make 100K, sure. Yeah, you're gonna pay tax on that. But like, what's your alternative in? Yeah. Well, it depends on how you make. Like, you make 100K that year. I think like 40. No, maybe not. I don't know exactly.
Technically, in Canada, it'd be a capital gain. You have a capital
Uh,
gains exemption of some, but generally 50%.
But I believe this wouldn't be a capital gain because it's like interest, right? Interest is income, no?
Yeah, then well, it depends if they'd give you a T5.
Yeah. No, you're not getting a T5
And I don't think
here,
you're getting
but-
a T5. So, again, however it comes back to you, yeah, it probably is interest, but whether it's carried as a interest
Yeah.
payment or as capital gain, I don't know.
Yeah.
Either way, it's a tax lawyer, and I don't even think
Well,
it's settled that much in many
and
countries.
Don't ask CRA because they're apparently wrong 80%, 87% of the time. So.
You seem to have good knowledge of that. So let's say like a worst case scenario, hypothetically, with all that leverage, because there's a lot of leverage involved in that game, which is good if you make money. But let's say like US dollars goes down above under US no Canadian dollars, let's say. So what happened to that? I mean, is it everybody's getting like liquidated, or if the USD is going down like crazy to the point where it's below Canadian dollars? So what would happen for this money game?
Just depends what position you have. Like,
okay.
If it's USD debt and USD collateral, it's chilling. It goes in, like,
Moving together.
up or
right?
down is relative to something always. So if you're USD relative to USD, it's chill. If it's USD relative to Bitcoin, and it just depends what relative. I also think that, I mean, there's a lot of like peer-to-peer off-ramping things. If you ever like this guy will e-transfer you. This, like, he's gonna, yeah, you can do up to 100K here. There's your 100K right there. But like, I'm joking, because like whenever you get money, government will ask, like, you want to buy a house? They're gonna say, where did you get this money from? So it's hard.
Always pay your taxes.
So it might be really rudimentary, but I'd benefit it, and hopefully other people benefit as well. The additional funds that are generated from these returns, 6, 8, 12, 15%. Forget about the leverage for a moment. By and large, the staking benefit is that I give my, like, say, Bitcoin to you, or not Bitcoin, my Ethereum to you. You then can put it into, I'm going to say I'm using the wrong term, claiming pool, and therefore get more fees as part of the Ethereum mechanism.
Depends. So Ethereum is, there's so many kinds of yield. Ethereum, you're talking specifically about staking, and the yield is coming from ETH has like this inflation rate. Like, more ETH is minted the same way like bank mints dollars, and that's to incentivize ETH stakers. It's like a security cryptography concept, which is nothing like.
So you get paid for running the machine for you,
You get paid for providing stake to machines that
Yes.
run the client.
because that's how Ethereum now works.
Yeah, but that's like a we didn't talk anything about that today. Although it is a valid strategy, like on Aave, you can loop staked ETH with normal ETH.
LSTs.
Yeah.
Okay,
regular-
so again, just what is the generation of? I give you $100 for your stablecoin now.
Depends on, so if it's me, like,
Yes.
let's say lending on Aave. So if I lend on Ethereum, let's say if I lend on here, I'm earning 7% on USDT. What is this coming from? It's coming from 4% paid for by borrowers. So the same way that the real world works, if I'm lending something, someone is borrowing, they're paying interest. The interest is gonna go back to the lender. That's like real economic value. Plus like 3% incentives from Plasma because they want to incentivize lender liquidity. So that's like, it's as if JP Morgan was to give JP Morgan stock to lenders, kind of vibe.
That has to come out of Plasma Markets profits.
Pocket. It comes out of their pocket, their token. So all the token holders, like, I don't know if you guys hold XPL, but like, yeah, we're suffering because of this.
Basically, that's a marketing cost for
It's a
them.
marketing cost. But that's a bad example. On Ethereum, there's no incentive, and you can get 6%. That's one kind of yield, lending. But Ina is like different kind of yield. So you give them $1, they're gonna take 50 cents of that and buy ETH. And they're gonna take the other 50 cents and short ETH. They're gonna collect the funding fee, which is for traditional finance people, this is like totally foreign. But like, there's this thing called perpetual swaps, and it's like the futures contract with no expiry. And if everyone is going long, like they do in crypto, if you go short, you're taking the other side, and you earn this like funding fee, which is like kind of like interest for having the leverage position open. And if you hold hard spot and one short, hedge out any price exposure, but you still earn the funding. That's what. Quite complex, but it's like it works on $15 billion. So that's Athena. And then there's like, then we talked about USD AI. You give them $1, they're gonna lend it to someone who wants to buy a GPU, and then financing, like everything under. But the best one.
I feel like lending is probably the best entry. Ave, I don't know, top dog, lending. Whoever wants to borrow.
And by and large, I know there's leverage in crypto markets and that sort of thing where, you're leveraged 100 to 1. But
two examples. I'm a Bitcoin whale. I want to buy a house. I'm gonna put my Bitcoin in Aave, and I'm gonna borrow USD, off ramp it, buy a house. Slowly pay back the interest. If Bitcoin pumps, I can even sell some of that Bitcoin and use it to pay back my loan. That's like real example. And then like crypto example is like what we just talked about. I put SUSDE as collateral. I borrow USDC. That USDC must come from a lender. I use that USDC to buy more SUSDE. I do this like recursive loop thing, and I'm paying more interest every loop to lenders, but I do it because I earn more profit from the collateral's yield. Like there's like, yeah, so there's those carry trades. There's like borrowing because you spend your Bitcoin without selling it. Like I don't want to sell my Bitcoin, but I want to buy a house.
You can also do like shorts on lending markets, like put up USDC collateral, borrow. I don't know, Bitcoin's gonna go down. Borrow BTC, sell that BTC into USDC. When it goes down, rebuy it for less money, pay back your loan, and pocket the difference. Just another way.
But there's a lot of borrowers, different kinds of borrowers. Yeah. You can see the chain. Yeah.
Yeah, or yeah, I don't know if you just want like 2 times exposure to BTC and you can eat the percentage difference. Yeah, put BTC up, borrow USDC, swap that into BTC. Cool, it goes up. Chill. I don't know. There's a lot of different reasons why you might want to borrow. Even being like, yeah, put BTC up. Oh, it's only 5% lending rate on USDC. Well, I've done all the research on M Apollo. I understand their strategy, what they're doing. I think they're transparent, whatever. And it's 18%. Well, I'll just put up my Bitcoin, borrow for 5%, and then go place it over there and earn the spread. Another option. Yeah, again, its own risks, but yeah.
A lot of loans on Aave. It's a good dashboard, but yeah, there's 30 billion of people borrowing. Who knows what for? I mean, who knows for? But.
Yeah, even if you don't want to borrow, you can just, lend to people, right?
You can view the historic rates. Yeah. It's not a market maker in the sense of like facilitating trades, but it's like algorithmic lending. Like you put, like it will liquidate you automatically. It will compute interest automatically. It's like
utilization is controlled by a curve. So like to, encourage liquidity and always being able to, withdraw. It's like, for 70% utilized, it's up to 8% borrow rate, and then it just exponentially goes up once there's too many borrowers. Then it's like 90% borrow rate. Then that doesn't make sense for anyone. So people start paying back their, and then it settles back down. I don't know,
Computer
whatever.
does all the work, but people parameterize the computer. Like the smart contract does all the work, but someone needs to say, oh, we want the optimal kink to be at like 92% utilization rate, and like there's like some smart guys who Aave pays like many millions a year to do this like risk management work. Yeah.
Yeah, then I guess like max loan to value, like depending on the collateral, how much should you be able to borrow against it, what's safe, etc. Yeah, still, I guess, say lending's a simpler area to start in DeFi, but you look into it, it can naturally get quite complex. A lot of things happening, going on.
What are the for a reason for the volatility? If, let's say, Bitcoin were to drop back again to $70,000, $60,000, is that going to undermine the whole system?
I guess, to be honest, I'm not as familiar, but there is potential for bad debt if liquidations on the collateral, that you're pulling your loans out against, just don't hit fast enough or something.
Same.
That's fine, bro.
There's
Yeah.
but there's the same sort of risks in the general economy too.
Yeah.
Yeah.
Risk. There's always risk, and like you're just basically trusting. So Aave is like there's two versions of lending in crypto. There's like Aave version, which is like one big bank that you trust, and then there's like Morpho or Euler, which is like everyone, like every different friend group can make their own bank, and then you trust your like the leader of that friend group to like parameterize the bank, and it's like more isolated, but it's also more flexible. But you're trusting whoever that curator is. Whereas in Aave, you just trust the Aave DAO to curate these things for you. And like there's things like debt cap, like only so much of the total collateral can be this asset, because we don't want the whole of Aave to be this PTSUSD November 2025. Only like capped max 0.4 bill of the whole pie can be this. Yeah, because like there's like many of these parameters: debt cap, loan to value, liquidation threshold, interest rate kink, like all of these things that like smart people play with to just make sure that in times of the main thing is when market goes down, is there going to be bad debt? And like your whole job is to basically make sure that there's no bad debt even when market goes down. Like, how do you liquidate wrapped Bitcoin? You need to sell it on a DEX. How much DEX liquidity is in that DEX? What happens if all of crypto is lending markets are trying to sell their wrapped Bitcoin on that one DEX at the same time? How much available liquidity will it be? How much slippage will it be profitable for liquidators? Like, there are smart people who like do all this math, and then they set the numbers based on the math. Like in Ibisu's docs, we have a risk report where it goes over our methodology. That's where I learned. But there's like a few different buckets of parameters that you need to worry about. We hired a professional, not me.
Cool. Well, thank you guys. We'll probably
Thank you.
wrap it up there.